The COVID-19 pandemic has caused an unprecedented fall in economic activity in Canada, and the recovery will require considerable monetary policy support. Our overriding message to Canadians is that the bank will be there to provide monetary stimulus for an extended period to support the recovery and to return inflation to the 2% target. We are facing many uncertainties, the biggest of which is the unknowable course of the virus itself. As a result, we cannot forecast with the usual degree of accuracy on our economic projections. Recognizing this, we decided to present a central economic scenario. The central scenario tries to balance the likelihood of better and worse outcomes, but it is highly conditional on the assumptions about the virus. In particular, we assume there will not be a broad-based second wave here in Canada, and most of the containment measures are lifted gradually. We also assume that the pandemic will have largely run its course by the middle of 2022 because either a vaccine or an effective treatment is widely available by then. Our policy discussions were guided by this scenario while recognizing the extreme uncertainty around these assumptions. In the central scenario, the Canadian economy shrinks by almost 8% this year, then grows by just over 5% in 2021 and by almost 4% in 2022. Now let me give you some context. Recent monthly data, particularly on employment, motor vehicle sales and housing, suggests that the Canadian economy hit bottom in April. Job growth resumed in May and accelerated in June. We now estimate that the economy contracted about 15% in the first half of this year. As deep as this is, it suggests the economy has avoided the most dire scenarios we laid out in the April Monetary Policy Report. In the third quarter, we expect to continue to see a strong rebound in jobs and output. There are many reasons why the recuperation phase may be protracted. Some businesses will close, while others will be unable to return to pre-pandemic levels of activity. Business and consumer confidence have been shaken, and consumers are likely to be cautious with their spending. And many people may find it hard to return to work, particularly if schools and childcare facilities cannot fully reopen. We recognize that the burden of this challenge falls disproportionately on women. The bank's actions were also unprecedented. We lowered the policy rate to the effective lower bound of 25 basis points and launched a range of liquidity facilities and purchase programs to keep markets functioning. This kept credit flowing and supported confidence. With core markets normalizing, we have scaled back some of the short-term liquidity facilities, but we are ready to step these programs back up if warranted. The Canadian economy has been hit by an unprecedented shock, which has demanded an historic response. The early signs from the reopening phase are positive, but we expect the recuperation phase to be bumpy and protracted. As the economy moves from reopening to recuperation, it will continue to require extraordinary monetary policy stimulus. The Governing Council will hold the policy interest rate at the effective lower bound until economic slack is absorbed, so the 2% inflation target is sustainably achieved. In addition, to reinforce this commitment and keep interest rates low across the yield curve, the bank is continuing its large-scale asset purchase program at a pace of at least $5 billion per week of Government of Canada bonds. This quantitative easing program is making borrowing more affordable for households and businesses and will continue until the recovery is well underway. To support the recovery and achieve the inflation objective, the bank is prepared to provide further monetary policy stimulus as needed. As always, our policy actions are grounded in our inflation targeting mandate. The pandemic is imposing uncertainty on inflation itself. Because spending patterns have changed, the Consumer Price Index doesn't accurately represent the spending habits of Canadians right now. So the bank has been working with Statistics Canada to create an adjusted price index that better captures today's consumption patterns. We talk about this in Box 2 of the Monetary Policy Report. The adjusted price index shows that inflation is probably not as low as the official CPI suggests, although the difference is not large. In the past couple of months, inflation by either measure has been close to zero. We expect it to remain below target while low prices for gasoline, clothing, travel, and other items are pulling it down, and while demand is weak. The pandemic has reduced both supply and demand in the economy, but we judge that the effects on demand are larger. As demand recovers and economic slack is absorbed, inflation will gradually move back up towards our 2% target. As we elaborated at some length in the Monetary Policy Report, we see the recovery proceeding in two phases. A first phase, the reopening phase, where we expect to see a pretty strong bounce back in growth, followed by a slower, more protracted, bumpier recuperation phase. Our message is that it's going to be a long climb back, and the Bank of Canada is going to be there through the full length of the recovery until economic slack is absorbed so that we achieve our inflation target. The message is interest rates are going to be low for an extended period. We haven't produced a regular projection, we produced a central scenario, and the reason for that is to highlight that our outlook is highly conditional on the evolution of the virus itself. We've assumed in this central scenario there is no widespread second wave, and hence there's no widespread second lockdown. We do anticipate that there will be localized flare-ups of the virus, and there will need to be localized restrictions. It's going to be very important that we're all well prepared for flare-ups in the virus. And we've been pretty cautious in our assumptions about when a vaccine or effective medications will be available. We don't expect that in the central scenario for about 2 years. When you look, clearly there's a lot of uncertainty about these assumptions. There could be a second wave that requires a broad-based lockdown. And if that happens, we'd certainly be knocked off our central scenario. We'd be well below the central scenario, and that would imply we would need more monetary policy stimulus to get back to our inflation target. On the other side, a vaccine could be developed or effective medications may be developed more quickly, in which case the recovery would happen faster. The reason, yes, as you've outlined, risks are tilted to the downside really because of the possibility of a second wave and the serious consequences that would have if it required a second widespread lockdown.